Well, good. Well, thanks for taking time to talk today. Just wanted to learn more about what you are doing there at Ranch Ventures and what you're finding out there in the market these days.
Sure. Where should I start?
Oh, well, how did you get into this? How did you start this fund?
Yeah, sure. So I ran business development for a strategic tech agency out here in the Bay Area for about 5+ years. And there was a lot of capabilities at the agency. We did everything from back-end development to front-end design to marketing to branding to content creation to recruiting. We were also a 3PL and pretty well versed on the e-commerce side, everything from point of sale to pick, pack, and ship to fulfillment. So the agency was working with a lot of high-end entertainment and sports brands, but I sort of came on board, worked closely with the CEO, ran business development, and helped build a portfolio of over 30 companies, mostly startups, where we would utilize our in-house services, resources, experiential knowledge to sort of help these companies grow. And we would invest in them, we would advise, we would trade our in-house services for equity, and then we had an incubator arm. So I got a very comprehensive education, real-world education on how things work out here in this, ecosystem, and that's the best way for me to learn. I sort of called it my Silicon Valley MBA program. And then in September of 2015, I kind of took a step back, realized, I learned pretty proficiently how to identify talent, what to look for in early stage companies, how to help them, how to apply my own skill sets and helping them scale. And my network started blossoming. All my friends were investors, founders. One of the projects we spun out of the incubator went through Y Combinator. I became a mentor at 500 startups, and I started seeing this trend happening where I was getting all this passive deal flow being sent my way from very trusted sources, and I couldn't do anything about it. And there was a couple of them that actually I had a chance to invest in 3 or 4 or 5 years ago, wanted to invest, didn't have the capital pool to pull from, and missed on some opportunities that ended up growing into $250 million to $500 million companies. So I finally got sick of it, and I want some upside. I think I have the confidence and courage to go out and do this and raise a small fund, and I think I'm in a unique position to find some success.
Well, so what is your investment thesis? What do you look for based on that experience? What do you think is a good deal?
Yeah, so I'm sector agnostic, stage focused. I'm mostly betting on people, but I sort of found this really unique stage of investment that really made sense to me, and from a risk-adjusted return standpoint, it's kind of the optimal way for me to invest. So what it basically is companies that I'm early stage, I'm pre-Series A, but there's been this sort of ramp up in seed extension, or some people call them bridge rounds. And there's been a bit of a negative connotation to a bridge round because people think, oh, well, the companies didn't meet their growth goals, and they're sort of struggling, and they need an insurgence of capital to kind of resuscitate them and keep them going. That's not the type of bridge round I'm talking about. I saw this really particular type of round that would happen between seed and Series A, where actually the companies were flourishing. They underestimated their growth in seed, and outshined and outperformed all of their KPIs and what they were their sort of growth milestones. And they needed an additional $1 million or so to kind of push them over the edge. And Series A, there's been a Series A crunch, and sort of the stipulations for Series A investments have gotten significantly higher in terms of the metrics that you need to achieve. So these companies are actually flourishing, but they need a little more capital to get them over the edge. They also don't want to be distracted with Series A funding. They don't want to break stride So they typically raise these bridge rounds in a stealth manner with their incumbent investors, and they raise it within, 2 or 3 weeks. It's a very easy raise for them because they're doing so well. The investors want to double down on their investment. And I sort of saw this trend happening and wanted to participate and started networking with all of my, investors and founders to sort of come in on these bridge rounds. I'm one of the only outside investors to come in on these bridge rounds. And then once I'm in, I sort of help them in a lot of different areas to prepare for the Series A. So it also puts them in a better position to negotiate better terms for their A, because in 6 to 8 months they'll just be in in just a financially better position. And so I just saw there was a disproportionate relationship between valuation and risk in this particular bridge round. I'm paying double from the seed, anywhere between $10 and $17 million, typically the cost of these rounds. But I saw that the risk is mitigated by an order of magnitude because I actually get to see that how the teams execute, how they run a company. I have metrics I can evaluate. I can see what their cost of acquisition is. I can see what their lifetime value of a customer is. I can assess churn. I can look at their per unit economics. I can look at their gross margins. You can't do that typically because it's typically pre-revenue, pre-product, and it's just an idea on a whiteboard or a prototype, or they're in beta, and it's just too early, so you're mostly betting on the team. I wanted a little more meat on the bone, and so there's still outsized return opportunity in these bridge rounds, but they just have more traction and more stuff for me to evaluate that makes me feel more comfortable in terms of writing a check.
And where do you find these deals? Are they in the major centers like the Bay Area, New York, or do you find them across the country or underserved markets?
Yeah.
Or
it's all throughout the U.S. I invest in the U.S. and Canada for Fund 1, and it's all referral-based. I sort of pride myself on putting a curated network of investors and founders together over the past 6 years or so, and I have and so all my deal flow is inbound, pre-vetted, from people that I, explicitly trust, and I see about 20 to 25 deals a month, and typically invest in one per month. And sector agnostic. Got 20 companies in the portfolio right now, and feeling pretty good about it.
Okay. And once you invest in somebody, is that usually part of a syndicate round, or do you lead the deal, or do you share that with others, or how does that work?
Yeah, I'm a super micro fund. My first fund was $1 million, and that was intentional. It was sort of put some points on the board, establish a track record, prove myself. So I didn't want to spend 2 years fundraising when it felt like really I could accomplish everything I wanted to accomplish with $1 million. So I write small checks, $50K, but I'd like to think, and I think my founders would sort of testify, that I add a bunch of value on the back end of being relatively lightweight on the cap table. So all those areas that I mentioned that I learned from the agency, I'm sort of applying into into helping the companies scale in these early stages, prep them for the Series A. Like I said, a lot of recruiting acumen and value that I can bring to the table, but also marketing, helping them with customer acquisition, helping them tell their story in the most effective way. So I don't lead rounds at all. My check sizes are too small for that, but I like to think that I underpromise, overdeliver, because there's an expectation when you write a small check that there's not going to be a lot of value that gets brought to the table, but I like to overcompensate for that.
Right. But then you must be fundraising, although not full time, but when the $1 million runs out, you'll be back raising money again for the next round, albeit not 25 or 50 or $100 million, but $1 or $2 million, it sounds like. So there's some fundraising in there, it looks like.
Yeah, so I'm already starting to have preliminary conversations for Fund 2. Fund 1 is almost fully put to work. So, yeah, there'll be a uptick in terms of assets under management for Fund 2, and that will allow me to write larger check sizes and also have more money on the operational side to build out some more valuable resources that we can bring to the table for our founders.
So it sounds like you use your trusted network more than you use, say, data analytics. You see a lot of groups using Crunchbase and other tools to crunch the numbers and find the right metrics out there. But at the same time, you are looking at KPIs. How do you balance the two?
Yeah, I think being a successful investor is a blend of art and science. So I get a sense about people, and I obviously evaluate some of the data and the science to sort of go with that. And if everything matches up, I don't necessarily have a checklist, but I keep my finger on the pulse of emerging trends, in the market, and then I sort of dig deep into the financials. I have the luxury of doing that because of the stages I invest in, like I mentioned. And so, it usually takes me a week or so to sort of get a sense about a team, a founder, as well as how they're executing. And then if everything lines up, I move relatively quickly in terms of writing a check.
Okay. And what about follow-on funding? Is there much left for follow-ons, or do you just do the one investment and that's it?
Yeah, there was a little bit of money on reserve for follow-on in Fund 1. I don't know if I'm going to have any money on reserve for Fund 2. I think that there's an argument that, if you have conviction in a company, it makes sense to write a larger initial check size than to hold money, because it can dilute your return multiple. There's also an argument on the other side that says if, you have one or two tape measure home run winners, you want to put as much money as possible behind them in subsequent rounds as well. So I see it from two different ways, but then there's the opportunity cost of that, of maybe missing out on other deals if you follow on every deal. So I think I'm going to meet somewhere in the middle, probably hold a little bit money on reserve for the companies that start to become the rocket ship, and but mostly apply to new investments.
Right. Well, they say your best return is on the first check, and everything after that is left. So there is the theory that maybe there shouldn't be a second check. It's either going to happen or it's not.
Yeah. I see it both ways. It's hard to predict how big the companies are going to get. In the follow-on rounds that I would participate in, Series A, maybe Series B, you still don't know if it's going to be, a $500 million company. And they're moving in the right direction, but you just don't know, right? I mean, that's the inherent risk of this asset class. I've seen companies go to close, $700 million in unrealized value back down to zero, right? So you just don't know.
Right. Well, there's quite a bit of competition out there for the good deals, of course. There's quite a bit of, there's 3,000 micro VCs out there now, and there is still quite a bit of money from standard VCs as well. And so you kind of have to have your niche, it sounds like, or you have to have your focus to have your place at the table. But what do you see out there?
Yeah, I've seen there's been an incredible growth, I think, of new venture firms over the past 6 years, and I think primarily, I think it relates to micro VC sectors. I think funds that sub $100 million funds has been ramping up over the past 6 years or so, and there's a bunch of data that backs that up. So I think there's some. I think that's because seed rounds, there's like 3 stages of seed, I think. I think there's pre-seed, I think there's seed, and then I think there's the seed extension. So seed has become sort of, there's been a chop up of seed into 3 specific tiers. And I think that may be a reason why there's more money going into the micro VCs. I think, from a market reality standpoint, I think we're existing in a low yield economy right now, and I think new managers face sort of it's a saturated field. So I think you're right. We do need to differentiate, sort of tell a different story, and have a strategy that we believe in and is sort of unique in terms of how we're going to get into the best deals as it is competitive. It's obviously, a weak liquidity environment. I think there's general fears of economic downturn. So all these things kind of come into play, and then of course there's been some sort of, the poor behavior by particular, bad actors in the space. I think the degree of difficulty in terms of raising a fund it's still it's not, it's still difficult to raise money, I think, but I think you mitigate that risk and you decrease that difficulty by, just having a track record, being a good overall team player and having a moral and ethical sort of alignment with the founders and being a partner, not just writing a check and sort of crossing your fingers and hope that it succeeds. So I think there are things that you can do to sort of put yourself in an optimal, position for success in terms of just fundraising, and then of course once you have the money, you have to sort of put that money to work in a very strategic way, and at some point, obviously, deliver returns for your investors. It's a tricky asset class though, because the returns are so far out. For us, we're basically raising a second fund, talking about our track record and our performance, and it's all completely unrealized. So we'll see if that's a deterrent for some new investors to come involved to get on board. But there's a lot of excitement, and there's signals you can sort of look at where our companies are moving in the right direction. It's all you have to go by. But I think I have testimonials from my founders that will talk about how I participate post investment and how hands-on I am in sort of helping them grow. I think I could have testimonials from investors. I think being likable and just being a good partner goes a really long way. And then providing the services that are a bit differentiated that actually move the needle for your founders, I think will help you get into the best deals. And then just networking with other investors, because the rising tide affects all ships. So if you can provide services that help companies put them in an optimal position for success, that helps, other, downstream investment firms and co-investors win as well. So the rising tide affects all ships. I believe in that. And if you could be material in helping to rise the tide, then, that will also help you get into the best deals. So yeah.
So when you're investing in your seed or post-seed companies, what kind of help do you see they mostly need? What is the one or two things that everybody really needs help with that you're providing value on?
I think recruiting is number one, and I have relationships with a bunch of recruiting companies, personal recruiters, recruiting firms where I sort of come to the table and identify the needs of what my companies need, and then really try to gung-ho bring in the best talent, and also try to stress that if it's for an executive role or a big hire, we want to overspend on top talent, because I don't think you can cut corners on those big roles. When you're talking about like a head of growth or head of B2B sales or an SDR or something like that, you really want to overspend on that in the early stages, because that can be a killer that can come back to haunt you later on. So recruiting is a big one. And then, a lot of tech companies sort of, they kind of neglect the area of marketing and branding and storytelling. And so that's one of my core competencies too, to really effectively explain to the customers, why this is an important 10x, an important service or product that they need to adopt into their everyday life, and that's going to bring them 10x level of value or innovation in their life. So, it's sometimes difficult to distill very complex technology and complex ideas, distill it down into very palatable, easily digestible narratives, and that's something that I really love. I love taking on that challenge, and I love helping my founders, come up with a way that is, come up with a story to tell about their company that's exciting and also very easily relatable, and short and not overly scientific and technologically complex. If they want to go down the rabbit hole and really get down to the tech and the science, we can do that, but high level, just really sort of explain in 2 minutes why they're so great, what they're doing, what's their competitive advantage, and why someone needs it.
Well, that's a great skill if you can help people tell their story better. I find a lot of people really don't put out there very well their story, and it makes it harder to raise funding. They want to tell you how the product works, and they want to tell you how they have great metrics, but they don't get to the why behind it. Why am I doing this, and why is this important? And that's been my experience been one of the secrets of sales success is to get past the what and into the why. And the story behind the company is always answering the why. And so that's a key skill I rarely see out there, but certainly would be value added to these businesses.
Yeah, absolutely. And I also, the companies that I invest in, I try to invest in companies that have some aspect of, social impact, social consequence. They're doing something good for the world. There's some kind of value that they're bringing to society. And so, triple bottom line companies, not just about, the economic value that they're bringing to the table, but it's also the social value as well as the environmental value. So there's some really exciting talking points in a lot of the companies that I invest in that are sort of, being neglected, or the company is sort of, not taking advantage of the sort of impact that they're having in the world. And I think from a customer standpoint, that actually matters in today's world. Like there's so much saturation in most verticals and most sectors. How do you differentiate yourself? And if it's doing something that, a customer buys into it and it's, making the world a better place, I think that gives you a clear competitive advantage. And I think that we need to talk about that right from the get-go in a way that's authentic and genuine and not too snake oil, like a snake oil salesman. We're not just saying it. We actually back it up. The company, that is the ethos of these companies. And so that makes my job easier when I come to the table and kind of try to help them in these areas. There's a compelling society value add that is making an impact. It's just it lends itself to a much more compelling story.
Well, that's great, and that's important too, to have a triple bottom line and have some community give back. And glad to see that's going on as well. Well, we're near the end of our time. Was there anything else you wanted to include in our wrap up?
No, just that we people are interested in learning more about what I do. I go to ranch.vc, and you can see a little bit more on me and my philosophy, how I invest, and as well as all the 20 portfolio companies I have right now. And yeah, if there's ways that people feel like they could be helpful, feel free to reach out.
All right. Well, thank you so much for taking time to join us today, and we'll go from there.
All right, I'll appreciate it. Thanks for the time.
So we'll cut it there and go ahead and wrap it up with music and put some show notes and put your URL on there as well for you to reference so people can get back in touch with you. If you want your LinkedIn profile up there, we can do that or not do that. It's up to you.
Yeah, sure. Whatever gets the word out.
Sure. I just don't want to. I'm leery about putting email addresses up there because the spam bots find that, and next thing you know, you're filling up your spam folder for no good reason. But
yeah.
Anyway, appreciate you taking time, and thought that went very well, and thought you had some really good points to make, and you really need investment thesis going on there as well. It sounds like it's working pretty good for you.
Yeah. Everything's moving in the right direction. I'm excited to start, raising. I mean, we've already started the preliminary conversations with some investors and family offices for Fund 2. We're just in the process of putting our materials together, and I'm going to go gung-ho, September, October, November to start corralling checks and get the second fund up and running.
All right. Well, very good. Well, look forward to the results of that, and again, appreciate your taking time.
All right, Hal. Thanks so much.
Thank you. Bye-bye.
Bye-bye.